please.
Well, thank you very much, Wolfgang. And as you see, we are innovating here, and we hope that you like it. So, ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. We will now report on the outcome of the meeting of the Governing Council, which was also attended by the Commission Executive Vice President, Valdis Dombrovskis. While the overall economic situation is expected to improve over 2021, there remains uncertainty surrounding the near-term economic outlook, relating in particular to the dynamics of the pandemic and the speed of vaccination campaigns. The rebound in global demand and additional fiscal measures are supporting global and euro area activity. But persistently high rate of coronavirus infection, the spread of virus mutations, and the associated extension and tightening of containment measures are weighing on euro area economic activity in the short term. Looking ahead, the ongoing vaccination campaigns, together with the envisaged gradual relaxation of containment measures, underpin the expectations of a firm rebound in economic activity in the course of 2021. Inflation has picked up over recent months, mainly on account of some transitory factors and an increase in energy price inflation. At the same time, underlying price pressures remain subdued in the context of weak demand and significant slack in labour and product markets. While our latest staff projection exercise foresee a gradual increase in underlying inflation pressures, it confirms that the medium-term inflation outlook remains broadly unchanged from the staff projections in December 2020 and below our inflation aim. In these conditions, preserving favourable financing conditions over the pandemic period remains essential. Financing conditions are defined by a holistic and multifaceted set of indicators, spanning the entire transmission chain of monetary policy, from risk-free interest rates and sovereign yields to corporate bond yields and bank credit conditions. Market interest rates have increased since the start of the year, which poses a risk to wider financing conditions. Banks use risk-free interest rates and sovereign bond yields as key references for determining credit conditions. If sizable and persistent increases in these market interest rates, when left unchecked, could translate into a premature tightening of financing conditions for all sectors of the economy. This is undesirable at a time when preserving favourable financing conditions still remains necessary to reduce uncertainty and bolster confidence, thereby underpinning economic activity and safeguarding medium-term price stability. Against this background, the Governing Council decided the following. First, we will continue to conduct net asset purchases under the Pandemic Emergency Purchase Programme with a total envelope of 1,800 billion euros until at least the end of March 2022, and in any case, until the Governing Council judges that the coronavirus crisis phase is over. Based on a joint assessment of financing conditions and the inflation outlook, the Governing Council expects purchases under the PEP over the next quarter to be conducted at a significantly higher pace than during the first months of this year. We will purchase flexibly according to market conditions and with a view to preventing a tightening of financing conditions that is inconsistent with countering the downward impact of the pandemic on the projected path of inflation. In addition, The flexibility of purchases over time, across asset classes and among jurisdictions, will continue to support the smooth transmission of monetary policy. If favorable financing conditions can be maintained with asset purchase flows that do not exhaust the envelope over the net purchase horizon of the PEP, the envelope need not be used in full. Equally, the envelope can be recalibrated, if required, to maintain favorable financing conditions to help counter the negative pandemic shock to the path of inflation. We will continue to reinvest the principal payments from maturing securities purchased under the PEP until at least the end of 2023. In any case, the future roll-off of the PEP portfolio will be managed to avoid interference with the appropriate monetary policy stance. Second, net purchases under our Asset Purchase Programme, APP, will continue at a monthly pace of 20 billion euros. We continue to expect monthly net asset purchases under the APP to run for as long as necessary to reinforce the accommodative impact of our policy rates and to end shortly before we start raising the key ECB interest rates. We also intend to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when we start raising the key ECB interest rates, and in any case, for as long as necessary to maintain favorable liquidity conditions and an ample degree of monetary accommodation. Third, the Governing Council decided to keep the key ECB interest rates unchanged. We expect them to remain at their present or lower levels until we have seen the inflation outlook robustly converge to a level sufficiently close to but below 2% within our projection horizon, and such convergence has been consistently reflected in underlying inflation dynamics. Finally, we will continue to provide ample liquidity through our refinancing operations. In particular, our third series of targeted longer-term refinancing operations, TLTRO, remains an attractive source of funding for banks, supporting bank lending to firms and households. Preserving favorable financing conditions over the pandemic period for all sectors of the economy remains essential to underpin economic activity and safeguard medium-term price stability. We will also continue to monitor developments in the exchange rate with regard to their possible implications for the medium-term inflation outlook. We stand ready to adjust all of our instruments as appropriate to ensure that inflation moves towards our aim in a sustained manner in line with our commitment to symmetry. Let me now explain our assessment in greater detail, starting with the economic analysis. Following the strong rebound in growth in the third quarter of 2020, Euro area real GDP declined by 0.7% in the fourth quarter. Looking at the full year, real GDP is estimated to have contracted by 6.6% in 2020, with the level of economic activity for the fourth quarter of the year standing 4.9% below its pre-pandemic level at the end of 2019. Incoming economic data, surveys and high-frequency indicators point to continued economic weakness in the first quarter of 2021, driven by the persistence of the pandemic and the associated containment measures. As a result, real GDP is likely to contract again in the first quarter of the year. Economic developments continue to be uneven across countries and sectors, with the services sector being more adversely affected by the restrictions on social interaction and mobility than the industrial sector, which is recovering more quickly. Although fiscal policy measures are supporting households and firms, consumers remain cautious in the light of the pandemic and its impact on employment and earnings. Moreover, weaker corporate balance sheets and elevated uncertainty about the economic outlook are still weighing on business investment. Looking ahead, the ongoing vaccination campaigns, together with the gradual relaxation of containment measures, barring any further adverse development related to the pandemic, underpin the expectation of a firm rebound in economic activity in the course of 2021. Over the medium term, the recovery of the euro area economy should be supported by favorable financing conditions, an expansionary fiscal stance, and a recovery in demand as containment measures are gradually lifted. This assessment is broadly reflected in the baseline scenario of the March 2021 ECB staff macroeconomic projections for the euro area. These projections foresee annual real GDP growth at 4% in 21, 4.1% in 22, and 2.1% in 23. Compared with the December 2020 Eurosystem staff macroeconomic projections, the outlook for economic activity is broadly unchanged. Overall, the risks surrounding the euro area growth outlook over the medium term have become more balanced, although downside risks remain in the near term. On the one hand, better prospects for global demand, bolstered by the sizable fiscal stimulus and the progress in vaccination campaigns, are encouraging. On the other hand, the ongoing pandemic, including the spread of virus mutations, and its implications for economic and financial conditions, continue to be a source of downside risk. Euro area annual inflation increased sharply to 0.9% in January and February 21, up from minus 0.3% in December. The upswing in headline inflation reflects a number of idiosyncratic factors, such as the end of the temporary VAT rate reduction in Germany, delayed sales period in some euro area countries, and the impact of the stronger than usual changes in HICP weight for 2021, as well as higher energy price inflation. On the basis of current oil futures prices, headline inflation is likely to increase in the coming months, but some volatility is expected throughout the year, reflecting the changing dynamics of the factors currently pushing inflation up. These factors can be expected to fade out of annual inflation rates early next year. Underlying price pressures are expected to increase somewhat this year due to current supply constraints and the recovery in domestic demand, although pressures are expected to remain subdued overall, also reflecting low wage pressures and the past appreciation of the euro. Once the impact of the pandemic fades, the unwinding of the high level of slack, supported by accommodative fiscal and monetary policies, will contribute to a gradual increase in inflation over the medium term. Survey-based measures and market-based indicators of longer-term inflation expectations remain at subdued levels, although market-based indicators have continued their gradual increase. This assessment is broadly reflected in the baseline scenario of the March 21 ECB staff macroeconomic projections for the euro area, which foresees annual inflation at 1.5% in 21, 1.2% in 22, and 1.4% in 23. Compared with the December 2020 Eurosystem staff macroeconomic projections, the outlook for inflation has been revised up for 21 and 22, largely due to temporary factors and higher energy price inflation, while it is unchanged for 23. Turning to the monetary analysis, the annual growth rate of broad money stood at 12.5% in January 21, after 12.4% in December and 11% in November 20. Strong money growth continued to be supported by the ongoing asset purchases by the Eurosystem, which remain the largest source of money creation. The narrow monetary aggregate M1 has remained the main contributor to broad money growth, consistent with a still heightened preference for liquidity in the money-holding sector and a low opportunity cost of holding the most liquid forms of money. Developments in loans to the private sector were characterized by somewhat weaker lending to non-financial corporations and resilient lending to households. The monthly lending flow to non-financial corporations continued the moderation observed since the end of the summer. At the same time, the annual growth rate remained broadly unchanged at 7% after 7.1% in December, still reflecting the very strong increase in lending in the first half of the year. The annual growth rate of loans to households remained broadly stable at 3% in January, after 3.1% in December, amid a solid positive monthly flow. Overall, our policy measures, together with the measures adopted by national governments and other European institutions, remain essential to support bank lending conditions and access to financing, in particular for those most affected by the pandemic. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is necessary to support economic activity and the robust convergence of inflation to levels that are below but close to 2% over the medium term. Regarding fiscal policies, an ambitious and coordinated fiscal stance remains critical in view of the sharp contraction in the euro area economy. To this end, support from national fiscal policies should continue, given weak demand from firms and households relating to the ongoing pandemic and the associated containment measures. At the same time, fiscal measures taken in response to the pandemic emergency should, as much as possible, remain temporary and targeted in nature to address vulnerabilities effectively and to support a swift recovery. The three safety nets endorsed by the European Council for workers, businesses, and governments provide important funding support. The Governing Council recognizes the key role of the Next Generation EU package and stresses the importance of it becoming operational without delay. It calls on Member States to ensure a timely ratification of the own resources decision, to finalize their recovery and resilience plans promptly, and to deploy the funds for productive public spending, accompanied by productivity-enhancing structural policies. This would allow the Next Generation EU programme to contribute to a faster, stronger, and more uniform recovery, and would increase economic resilience and the growth potential of Member States' economies, thereby supporting the effectiveness of monetary policy in the euro area. Such structural policies are particularly important in addressing long-standing structural and institutional weaknesses and in accelerating the green and digital transitions. Thank you very much. We're now ready to take your questions.
Thank you very much, Madame Lagarde. And as the President said, we have changed a little bit the setup and the visual of the press conference, and we hope you like it. And now the first question goes to Johanna Treek of Politico EU. Johanna, please.
Yes, thank you very much. This is Johanna. Ms. Lagarde, you announced that the ECB will significantly increase the bond buys over the next few months. Given the inbuilt flexibility that you have, what has kept you from increasing the purchases so far? And my second question would be, you said significantly. Could you perhaps quantify that for us a little bit? Where does it start? At 25 billion a week or closer to 30 billion a week? Thank you very much.
Well, thank you so much for your question. So your first question is really why did we not start a bit earlier? And I think the answer to that is that, of course, we have flexibility, but we made a commitment back in December that we would preserve favorable financing conditions that would entail tightening that would be that would prevent us from actually following the inflation path that serves for us as the anchor of our policies. So you have on the one hand flexibility, you have on the other hand a commitment to preserving favorable financing conditions and a clear link to the inflation outlook. This is clearly a monetary stance decision, and therefore one that requires the Governing Council to be involved. And given that we were a few days away from Governing Council meeting on monetary policy, number one, and that we were a few days away from having the provisions provided by ECB staff, we thought it would certainly be a better idea to do the analysis or the joint assessment that we want to conduct in order to determine what kind of increase, significant increase, as you rightly said, would be needed in order to respond to the commitment that we made. So do I have a number in mind to explain significant? The answer to that is no. And no for a very specific reason, is that we want to deliver on our commitment. That commitment made in December, as I said, was to preserve favorable financing conditions. Point number one. Point number two, we have full flexibility under PEP. That is, you know, the cornerstone of PEP. But to actually assess jointly favorable financing conditions, determine their favorability in relation to the inflation outlook, we are not bound by any particular specific number. So what the Governing Council has decided is to, and I'll read exactly the sentence because I don't want to stay away from what was decided by total consensus, by the way. The Governing Council expects purchases under the PEP over the next quarter to be conducted at a significantly higher pace than during the first month of the year. So this is what what has been decided by consensus of the Governing Council. Significant increase of the purchases. We are looking at a time horizon of a quarter, which conveniently coincides with the staff provisions that we receive on a quarterly basis, and which will enable us to actually identify whether the financing conditions have evolved, remain favorable, and actually help us to counter any downward pandemic effect on our inflation path. Now, I'm also happy to explain exactly what we mean by financing conditions and favorable financing conditions, because I know that this was a question that many of you had. So, shall I do that? Yes. And I'm sorry if I'm stealing the thunder of some of those who wanted to ask that question, but I know that it's a question that is on your mind. So, when we measure financing conditions, I use two words that some of you found either questionable or a bit strange. I use the word holistic, and I use the word multifaceted. It wasn't a fancy or a tantrum on my part. It was very targeted at particular indicators. So let me take you through the holistic first. What we mean by holistic is that we cover the whole chain of transmission, from upstream stage, where you find the risk-free interest rate, where you find the sovereign yields, to the downstream aspect of the credit terms. And that clearly includes a multiplicity of rates that we all look at as well. And it has to do with a stage where monetary policy acts with a lag. So upstream, essentially down to interest, to risk-free interest rate, sovereign yields. It's a segment that actually responds quite rapidly, which is measured on an ongoing basis, and where our monetary policy can be most efficient. But that's not enough. What's important is that actually financial institutions, those that provide financing to the economy, actually use those rates to determine the credit terms that they are then going to offer. So that upstream is clearly an important component, but it is not the component of our assessment of the financing conditions, which is why I use the word holistic. We go from upstream to downstream. And the second word that I used, which is multifaceted, was also apparently a bit of a puzzle for some. Well, multifaceted, we organize information in a multidimensional form. That might be more convenient for some of you, where each indicator can be studied in its own right, and assessment is not based on an aggregated synthetic measures. So we don't operate mechanically. We look at all the indicators. We focus indeed on what is upstream because that's where we can act, and that's where banks and providers of financing actually take their clue about the credit terms that they're going to offer. And it's also important to be multifaceted, because there are some downstream components that are not necessarily going to be influenced by upstream movement. Take, for instance, some fiscal measures that have rightly been decided, such as providing moratorium or guarantees. If that was withdrawn, well, clearly it will have an impact on the downstream aspects of the indicators. In the same way, our TLTRO is also helping the downstream aspect of what we're looking at. So that's the reason why we look at financing conditions, looking at the upstream, the downstream, but looking at them in their own right, in a holistic way, all of it, the whole transmission chain, and each and every one of them, because they might respond differently depending on what is addressed to them. Now, the second question, of course, is how do we assess favorability? Well, if you look carefully at the introductory statement, we refer to a joint assessment of how financing conditions and our inflation outlook have evolved since last time we identified favorability and concluded with our assessment. And we look at the main drivers, of course. So, concerning the anchor that I have used as well last time we had the press conference, it's the inflation outlook. The assessment of the financing conditions, determination of how favorable they are, is going to be done in conjunction with the inflation outlook. And the compass that we have, another word that I used as well, are the financing conditions. So we use all that, and with a bit of good work, good analysis based on provisions and this joint assessment, our monetary policy will contribute to taking the economies across the bridge of the pandemic that we are suffering from and have been suffering from for the last year or so. Thank you.
Thank you, Madame Lagarde. And the next question goes to Alexander Weber of Bloomberg News. Alexander, please.
Good afternoon, President Lagarde. So on the rise in bond yields, we've heard different views from governing council members in the past few weeks, and some said that it can be warranted if it reflects a better outlook. So which arguments were presented over the last few days, and what exactly led you to conclude that bond purchases must pick up in the coming quarter? And then also a second question on this change in language. Should market participants expect a change in the pace of PEP purchases only after governing council meetings? So do you think it's important to first build a consensus on that? Thank you.
Thank you very much. On your last point, as I said, quarterly basis is very convenient because it helps with having the right data, the right assessment, the provisions of our staff, sometimes checked by the national central banks as well twice a year. So we have fresh data, fresh information that is extremely useful in order to look at these two components that I have discussed. The anchor, inflation outlook, how does it evolve, how does it look like in the medium term, and the compass that we use, which are the financing conditions, which we committed to preserve as favorable in order to resist the downward impact of pandemic on our inflation path. So we're not monitoring on a weekly basis. I know that some of you listening are looking at weekly numbers. Fair enough. But the Governing Council is not micromanaging the operations. And on that vein, actually, I would like to tell you that when you look at this coming Monday, don't expect a huge, big rise, okay? Because the decision was taken today. We have still a good volume of redemptions this coming Monday. But I can also tell you that we're beginning to implement the decision that was taken today to significantly increase our purchases as of today. So the real pace on a weekly basis, which some of you are interested in, is not going to be visible or strongly visible this Monday. But again, we're looking at a time horizon which is longer than the next week. And the Governing Council meets any time when it's needed. We're getting very close to the first anniversary of days when we were meeting almost on a daily basis. And that's when we started PEP. So if it is necessary, in order to respond with flexibility and to deliver on our commitment to preserve favorable financing condition, the Governing Council can always meet. But clearly the Executive Board can also use the flexibility that is embedded in the program in order to actually deliver on the decision that was taken today, which is to use flexibility in order to significantly increase our purchases. Thank you.
Thank you, Madame Lagarde. And the next question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon. Thanks for taking my questions. First one is about the goals of your decision today. I'm curious, is your aim to improve financing conditions compared to where they were, let's say, this morning, or to preserve the levels you have now? And if you want to improve them, what is the benchmark? Philip Lane put up some charts a couple of weeks ago showing curves in December. Is that your goal, to go back to the December level, or where is the favorable financing conditions level? And the second question is, did anybody at the table suggest, propose, or make the argument for increasing the total envelope for PEP? Thank you.
Well, let me remind you once again that when we assess favorable financing conditions, we do it with a series of indicators that go from upstream to downstream. I think that Philip actually in his recent speech very clearly indicated what was the composition of those upstream and downstream elements and what was the interconnection between the two and why the upstream actually mattered, without prejudice to us also looking very carefully at the downstream. So we do that on the one hand, and to assess favorability, we look on a quarterly basis at the inflation outlook. And on the basis of the commitment we made to preserve favorable financing conditions, that determines the decision that is made by the Governing Council. And on the occasion of this particular monetary policy decision, the Governing Council, by consensus at the table, decided that it was warranted to significantly increase purchases for the next quarter with the monthly reference. So, there is no reference to a particular day. There is no reference to any kind of yield curve control, if it is the question that you are angling to. We're not doing yield curve control. We are preserving favorable financing condition with a look at the inflation outlook that we have and how one contributes to reducing the downward impact of the pandemic on our inflation path. Thank you.
Thank you very much.
Total envelope.
Oh yeah. You asked about the envelope. Well, look, what we did with the envelope was quite spectacular, I would suggest. It was decided on March 18. It was subsequently increased by 600 billion euros in June. It was then again increased by 500 billion euros in December. And in December, we clearly focused on the preserving favorable financing conditions. If I have not repeated it 10 times, I don't think I will have said it. So that's what we did. And for the moment, we probably have about 1 trillion euros left in the envelope. And it's very clear also in the introductory statement to preserve favorable financing conditions. If we need less than the whole envelope, we will not use the whole envelope. If equally, to preserve favorable financing conditions, we need to recalibrate the whole envelope, we will do so. So again, it's flexibility in the monthly purchases under the quarterly decision that is made by the Governing Council, and it's flexibility as to how we use the overall envelope during the life of PEP. Thank you.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Hello, thank you very much for having me. A couple of questions first on the headline inflation that is likely to increase, as you said. The problem, of course, is you justify your intervention by saying you needed to increase inflation in the past. If headline inflation gets to 2%, what arguments are you going to use to justify your intervention? And one other question, if I can, on climate change. You had a paraglider on your roof yesterday. You debated the issue, I think, a few weeks ago, and the leaks were that the ECB intervention might not extend to choosing bond buying according to the CO2 emission of companies. Is that correct, or will you keep the market neutrality mantra?
Well, thank you so much for the two questions. On the first one, let me make a few comments about inflation. Because if you look at the staff provisions that will be released later this afternoon, you will see that our inflation forecast is of 1.5 for this year, and then moves down to 1.2 and then 1.1 and finishes in 2023, which is our medium-term horizon, at 1.4. It is possible that this year, particularly at the end of 2021, inflation actually hits 2%. But I will tell you something. We will see through that for a very clear reason, and that is that inflation will most likely go up, possibly to 2%, because of some technical and temporary reasons. Let me just mention a few, and we can go through the list. But it's number one, the VAT, the German VAT return, which has had an impact, an upward pressure on prices. It is the significant modification of the weighing in the HICP balance to adjust to the change of consumer behavior and consequences that it has in 21. It has to do with some idiosyncratic factors having to do with, I think, Italy and France that have extended into 21 some of the sales, particularly in the clothing industry. And it has to do, of course, with the increase in prices in the oil segment. So for all these reasons that are, we believe, temporary, technical, as I have just tried to explain, we will see through that. And it is important for us to actually look at what happens next and to look at the medium-term inflation outlook. And there, we are clearly inflation. Why is that? Well, because demand, subdued demand. Second, because of the slack in the economy that will gradually, over the course of the recovery, reduce, but which is large and has a significant impact. Wage pressure. There is clearly limited pressure up on wages, and also the impact of the euro appreciation. So for all these reasons, we believe that while it has increased a little bit in the first 2 years, on the third year, we are still at 1.4, which is far away from our inflation path pre-pandemic, and of course far away from our aim, which is close to but below 2%. So that's what I really wanted to explain in relation to inflation. That's how we see it, and clearly inflation, our inflation aim and our inflation path pre-pandemic remain two very important anchor of the monetary policy decisions that we will make. Thank you. Oh no, question about climate. So I think that it is almost unanimous within the Governing Council that climate imperatives are nothing less than imperatives. And I have said repeatedly that it is the biggest challenge that is addressed to us. Hence, in my view, any institution, whatever its mandate, whatever its remit, has to question itself and wonder what can be done. Now, obviously, an independent central bank has to deliver on its mandate. And we need to do that, and we need to look at what we can do in compliance and in respect of our mandate, without overinterpreting the mandate, using this primary objective, which, in my view, justifies fully that climate change matters be actually taken into account for various reasons. The integrity of prices on the market, a good risk management, appropriate supervision that falls under the responsibility of Andrea and Ria. But on all those accounts, we have to explore what we can do, how efficient we can be in doing so. And to your very clear question, it will apply, of course, to how we value collaterals. It will apply to how we value corporate bonds, with proper risks being taken into account. Now, at this point in time, the main responsibility, in my view, in the view of the Governing Council, lies first and foremost with governments, and governments at the European level, and Europe is delivering in that respect, but with governments in the various member states. And there will be a staged approach where clearly information, disclosure, investment will all be required in order to address the climate change issue. So while we are, on the same page in many ways with some of the civil society organizations, we cannot help but regretting enormously the approach, the conduct that was adopted, which clearly by paragliding on the roof of the ECB is exposing people's health, life possibly, and we don't think that this is the necessary way to conduct a dialogue. But we will definitely continue this dialogue.
Thank you, Madame Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Hello, Madame Lagarde. For you, thank you for letting me ask them. Firstly, your colleague Fabio Panetta cited the Daft Punk song "Harder, Faster, Better, Stronger" and calling for the ECB to do more. Do you think that by accelerating the pace of your bond purchases, as you promised to do, that satisfies that call? And secondly, can you tell us whether your latest economic forecasts include the effect of the $1.9 trillion stimulus program that's just being voted through in the US Congress? Thank you very much.
Thank you, Mr. Arnold. Those are two really good questions, actually. First of all, I'm delighted that my colleague Fabio Panetta decided to quote a French group. He could have borrowed from Baron Coubertin, who used some of that as well. And, I go back again to the introductory statement and will be happy to read it again, although you have it in front of you, I'm sure. But when we say, the Governing Council expects purchases under the PEP over the next quarter to be conducted at a significantly higher pace than during the first months of this year. And when I tell you that we are moving into action as early as tomorrow, I think that fits the bill. Now, you will find some that will want a little more, a little less, a little this, a little that. Suffice to say that there was consensus at the table of the Governing Council today to do exactly that, conduct a significantly higher pace of purchases during the first month of this, during the next quarter, as compared with the first 3 months of this year. Now, very good question on the issue of the massive fiscal stimulus that is likely to be signed into law probably today, and will give, knowing Treasury head Yellen, the efficiency that she has, I'm sure that there will be immediate implementation. The answer to your question is no, because of rules that many of you are familiar with. Until a piece of legislation is voted, we cannot take that into account. So, it was voted yesterday. It will be moving into law tomorrow. Hence, it is not embedded in our provision. But we do, and actually the introductory statement makes reference to the external demand, to the impact that a massive fiscal stimulus will have on our pace of growth, that it will have on trade, of course. So we believe that the Biden plan is actually going to have an impact. Not to be overestimated, though, because clearly there will be a lot of domestic measures that will impact predominantly the US domestic markets. But it will have an impact, an external demand that is addressed to the euro area and to other countries, of course, will generate probably and will have an impact on our growth projections. And that will indeed be reflected in 3 months' time when we produce our June provisions. One thing that I will say is that the big difference, if you will, between the Biden stimulus, which, as I said, debated, voted by the two houses, signed into law, checks in the mail, and our massive fiscal stimulus here in Europe, is that there is a bit of a lag time between the two. And the next generation EU, as we say in the introductory statement, is critically important in order to help stimulate the European economies from a fiscal point of view, and is also terribly important for two other reasons. One, because it needs to address the issue of heterogeneity between countries and between sectors, and it needs to focus on what will be productivity enhancing and moving our economies and our Europe into the future with the focus on digital and green. But there is a time lag between the two, let's face it. So while we import a bit of yield increase, the trade movement are going to come, but our own fiscal measures are not kicking in yet. And we need that. We need that. Thank you.
Thank you. And the next question is going to Jan Malin of Handelsblatt. Jan, please.
Madame Lagarde, you had said that you have not taken the Biden stimulus into account, but could you maybe elaborate a bit on how it has already resulted in inflation expectations rising significantly in the US? Could you maybe say something how this will affect the medium term, this global developments affect the medium outlook for inflation in the euro area? And you have kept your inflation projection for 2023 at 1.4%, so very much below the target for the medium term. So why actually didn't you do more from a monetary policy perspective? Thank you.
To the risk of boring all of you, I think that when the Governing Council, by full consensus, decides that purchases under the PEP over the next quarters will be conducted at a significantly higher pace than during the first months of this year, it is not an insignificant commitment that they're making. And I remind you that it comes on the top of the monthly 20 billion euros that are purchased under the APP. So I think that there is a serious taking into consideration of the undesirable yield increase that we are seeing, that we have seen in the last few weeks, portion of which certainly is attributable to the inflation expectations and the GDP growth expectations in the United States. And that's to my point of the time lag. I hope we can move fast on the fiscal front here in the euro area. Now, obviously, staff here at the ECB has been very diligent looking at the Biden plan and trying to assess on a very preliminary basis what the impact will be on both growth through the trade channel in particular, and also on the inflation expectations and particularly on the inflation outlook. And there will be some impact. It's pretty clear that will be reflected in future provisions because this has not been taken on board this time around. I think they also want to have a look very carefully at what is eventually delivered after the signing into law of what has been voted yesterday by the House of Representatives. Thank you.
Thank you. And the next question goes to Domenico Conti of the Italian newswire ANSA. Domenico, please.
Hello, thank you very much for this occasion. Madame Lagarde, one question that I have would be about, I know that you've been over the how to preserve financial conditions, just about the purchases that you are intending to make in the coming quarter. Are you targeting a particular segment of the yield curve? I'm asking this in the context of this sharp rise in sovereign yields in the longer part of the curve that we've seen globally. And if I may, one second question is about the ongoing discussion on setting a European bad bank or a network of national asset management companies. Can you give us a hint of what this discussion is leading to, whether there have been some developments? Thank you very much.
On your first point, the answer is pretty easy. No, we are not focusing on any particular segment of the yield curve. We want to look at the entire yield curve. And well, it comes to mind that the 10 years sovereign yield is one that is often referred to. It's not the only one. And we will look at the entire yield curve, which has evolved in a slightly different way, depending on whether you are in these sort of 2 to 5 years or way beyond, including up until 30 years. So we will look at all of it. As I said, it's holistic. I'm not going to take you through that again. I hope it's what we mean by holistic is clear enough. What we mean by multifaceted is clear enough as well. And I know those are not usual words for this particular kind of press conference, but never mind. We can always expand our vocabulary as long as we know what's behind it. So the entire yield curve. On the asset, on the European asset management, the ECB is continuously monitoring the impact of COVID-19 crisis on banks. A large-scale, system-wise increase in NPLs would require a comprehensive approach at the national and EU levels. Now, based on the development and the monitoring, different policy options are being considered and could be further explored. And certainly at the ECB, we have taken note of the Commission proposal to asset management companies that would operate at the national level. And we agree that this is a useful way to manage a systemic NPL problem. As you know, also, my colleague Andrea Enria has had in mind a more pan-European approach. This might come along later, but I think the key urgency is to make sure that there are mechanisms in place that can deal with the risk that bears on banks. Thank you.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you. Thank you very much. Madame Lagarde, I have two questions as well. One would be on the still high euro exchange rate, because clearly, despite all the easing measures, the euro is still very close to that 120 benchmark towards the dollar. How much is that a concern for you and your inflation outlook? And the second question would be more in your capacity as like a global leader. Currently, there's discussion about easing or perhaps changing the Stability and Growth Pact also in response to that unprecedented crisis and the unprecedented debt levels. Would you think that's a good idea?
Okay, on your first question concerning the appreciation or the level of the euro at the moment, I have said that before. I'll repeat it again. We're not targeting any particular exchange rate for the euro, but equally, we monitor very carefully the development of rate, because clearly they have an impact on economic activity and the outlook for price stability in the euro area. It has been quite volatile lately, and we do monitor carefully. I think in the current environment, the ECB will continue to monitor developments in the exchange rate, but we don't focus on the exchange rate as such. We focus on the impact that it has on prices and the implication that it has for the medium-term inflation outlook. Your second question on the Stability and Growth Pact. First of all, I would like to observe that although it's in the remit of the Commission and the Council, the decision to extend or to activate the escape clause, to keep it alive, if you will. I never know whether it's activate or deactivate, but to keep it in place. In other words, escape is allowed, and some of the current constraints under the current SGPs are waived. Their decision to extend it until such time when the European economies are back to pre-COVID-19 is, in our view, the right approach. We are not decision makers in that. We are consulted, and this is certainly the position that we would take. And to the extent that under their winter provisions, the Commission foresee the return to pre-COVID-19 mid-2022, this is actually appropriate in our view to keep that waiver until such time. Our hope is that by the time when the escape clause is deactivated and constraints return, SGPs will have been revisited and will have been improved in order for it to be more simple, more focused on productivity, investment, and also, indeed, with fiscal discipline embedded, but probably with a renewed look at what criterias, what measurements are used. You know, it was decided back in the 1990s, and that the situation has changed significantly since those days. So it's only fair to look at it again and to see what is mostly needed in order to give both stability and support solid, sustainable and stable growth going forward. Thank you.
Thank you, Madame Lagarde. This brings us to the end of today's press conference. Thank you very much for joining. We will see you again on the 22nd of April, our next scheduled press conference. Up until then, I hope you all stay safe and healthy and have an excellent afternoon. Goodbye.
Goodbye.